Hey everyone, welcome back to In Layman's Terms, your go-to channel for deciphering the world of personal finance without the jargon. Today we're demystifying the world of stocks, also known as equity, in the most simplest way possible. But before we jump in, as always, remember guys, life's complicated enough, but your personal finances don't have to be. Having said that, let's begin with our video. Alright, let's start with the basics. What are stocks? A stock or an equity is a security that represents ownership in a corporation. Unit of stocks are called shares, and they entitle the owner to a portion of the company's assets and profits proportional to their ownership. If you own a stock in a company, you're called a shareholder, and because you share in the company's profits. But why do companies offer stocks? Well, they issue stocks to raise funds for their operations, like expanding their business or funding a new project. It's like asking people to become part owners of their dream. This is called an initial public offering or an IPO. Here is an example. Imagine you have a lemonade stand and it's doing really well, but you want to expand and sell more lemonade. To do that, you need more money to buy more lemons, sugar, and cups. So you decide to ask your friends and family to invest in your lemonade stand by buying shares. Each share they buy represents a small piece of ownership in your stand. This way you can raise the money you need to grow your business. Let's say your lemonade stand is worth $1,000 and you decide to issue 100 shares. Each share would be worth $10, right? If your friend buys 10 shares, they give you $100 and they own 10% of your lemonade stand. Now with the money from selling shares, you can buy more supplies and sell more lemonade. And if your business does well, the value of each share might go up. Your friend could sell those shares later on for a good profit. In the business world, companies work very similarly. They issue stocks to raise funds for various reasons, like expanding their operations, developing new projects, or paying off debts. Just like in the lemonade stand example, when people buy these shares, they become part owners of the company and hope to benefit from its success. There are two main types of stocks, a common stock and a preferred stock. Common stock usually comes in with voting rights and dividends, while preferred stocks have priority in assets and earnings in case of liquidation. Let's dive a little deeper into this. Common stocks are like regular tickets to a company's show. When you own a common stock, you have the right to vote at the company's meetings, and you may get a share of the company's profits in the form of dividends. It's like having a say in what the movie night should be and getting a slice of the pizza. You can vote on who runs the company, and if they make money, you might get a dividend check in the mail. Common stocks are the most typical kind of stocks that average investors can purchase. Now let's talk about preferred stocks. Preferred stocks are a bit like a VIP ticket. You don't usually get to vote on companies' decisions, but you can get first dibs on the profits and assets if the company is doing well. It's like being at the front row of a concert. So you're the first to get the best goodies. Even though you can't vote, you'll be the first to receive dividends and assets if the company is sold. Alright, most often stocks are bought and sold on stock exchanges, such as the Nasdaq or the New York Stock Exchange. After a company goes public through an initial public offering or an IPO, its stock becomes available for investors to buy and sell on an exchange. Typically, investors will use a brokerage account. Some examples, Robinhood, Webull, and other brokerage accounts. And they purchase stocks on this exchange, which will list the purchasing price, the bid, or the selling price they offer. The price of the stock is influenced by supply and demand factors in the market, among many other variables. Lastly, now that we know what stocks are, you may have a very natural question. Why should I invest in them? Well, investing in stocks is a bit like planting a money seed. You hope that over time, the seed will grow into a money tree. Now let's dive a little deeper into this. The first point, potential for growth. When you invest in a stock, you buy a piece of a company, as I mentioned before. If that company does well and makes a good profit, the value of your piece, that's the stock, can grow. It's like watching your money tree grow taller. and you can sell the tree, the stock in our case, later for more money than you paid. And the second point is dividends. Some companies share their profits with stockholders by giving them a portion of their earnings. It's like getting a piece of the company's pie in the form of money called dividends. You can use these dividends or you can reinvest them to make your money tree even bigger. In conclusion, stocks represent ownership in a corporation and are issued by companies to raise capital. Common and preferred stocks have different rights and benefits. Remember, all investments come with some sort of risk, but stocks have historically outperformed most other investments in the long run. Having said that, thank you for watching my video, guys. I hope you found this quick overview of stocks helpful. If you did, please don't forget to hit that like and subscribe button, and feel free to comment down below with any questions or any suggestions that you have for the next topic in our video. Before I leave, as always, remember guys, personal finance doesn't have to be complicated. It can be as clear as a day, just like our channel's mission. Having said that, I'll see you guys in the next video. Bye!